Mhm. Oh, sorry, momentarily. I was saying it wouldn't let me share. It said no. Can you see it?
Yep.
Yep.
Cool. It kept saying error, so I don't know. Okay, so John, do you wanna?
Yeah, I'll call us to order. I don't know if somebody else wants to kind of take over from there though, since I've been I've been a non-participant up to this point, other than a quick discussion on Friday. So I'll call regular meeting to order of the Audit Committee, Tioga County IDA 1004. I am here. Eric Knowles
Here.
here, and Brenda.
Here.
All right, so we got all of us here. Casey's a guest. Britt's not on the call, is she?
She is. I'm here.
Oh, she is. Okay, Brittany's here. Lisa, and then Ashley from Bonadio. I guess I can go through, and our last audit committee minutes are in here from last year's similar session. Anybody have any question on those?
I move we approve them.
Second.
All right. All right. We are in agreement on that. And outside of that, we'll head into the new business, which is the 2025 draft of the audit. And whoever wants to take over on that piece.
All right. Would I be able to share my screen?
Yeah, sure. Here, I'll click stop sharing.
Awesome. Because I just highlighted a couple of things so I don't have to, because obviously you guys don't want me to go through every single page and read every single page. So wanted to pick out some highlighted pieces to go through with you guys. It looks like I have to send a request to share my screen.
Clicked allow, so let me know if you have issues.
Perfect. Let me know when you guys are able to hopefully see a PDF.
Yep, we got it.
Awesome. So the first deliverable document I want to go through with you all is what we call the required communications letter, and that's exactly what it is. It lists out items that we're required to communicate with you at the conclusion of our audit. And the few things I wanted to pick out, the IDA did not adopt any new accounting policies during 2025 that would have a material impact on their financial statements. They do have a couple of estimates affecting their financial statements, which includes the useful life of capital assets, along with allowance for uncollectible loans, and we're required to communicate those with you guys as well. We didn't encounter any significant difficulties during the audit. But we did note that we do have some corrected material audit adjustments that we'll take a look at shortly. We didn't, like I said, no issues or disagreements arose during the audit. And you'll see this a few different times through our reporting. We're required to disclose to you that the management's discussion and analysis is a required part of the final audit report, but this is an unaudited section of the report. Therefore, we don't provide an opinion on it. So you'll see that a couple of more times. If I go on to the attachment at the end of the letter, this reflects the two material audit adjustments we made to the IDA's trial balance and ultimately the financial statements. So the first adjustment relates simply to a accrued expense that we identified during our testing that was not recorded in accounts payable at year end. So we went ahead and recorded the expense in accounts payable, but then we further noted it was an expense related to a grant program. So on the same entry, we in turn recorded accounts receivable and grant revenue, as those funds will be reimbursed to the IDA, and in turn, those funds get passed through to the subrecipient of that grant money that the IDA is reimbursing. So that was the first piece of our adjustments. And then the second one, this journal entry looks probably bizarre. It's a combination of things, but overall, looking at it, it's correcting grant activity reported in 2024. So overall, we had some timing issues with grant activity in terms of it being recorded in the proper year. So we had some stuff recorded as revenue in 2025 that should have been in 2024 because it was actually earned then. Same thing with the related expenditures and expenses incurred. They should have been recorded in 24 and they weren't until 2025 when they paid. When they were paid, like the cash went out. So this entry, looking at it, I am sure does not make any sense. So I'm hoping once we look at the financial statements along with our restatement disclosure, that makes it look a little bit more easier to digest and understand. I'll answer questions as needed when we get there. Before I switch over to the next document, does anyone have any questions? All right. The next one I want to go over briefly is what we refer to as our investment compliance letter. All this is a required communication that we let you guys know that nothing came to our attention to make us think the IDA isn't complying with investment guidelines. However, our audit wasn't directed towards testing for non-compliance with investments. So that's just a required communication we're required to share with you guys. So with that, I can finally move over to the financial statements. So looking at the independent auditors report, we issued what is called a qualified opinion, and I like to refer to it in many cases as the except for audit opinion. So what we ended up doing is that we believe everything else is fairly stated in accordance with accounting standards, except for one piece. And that piece, as you can see under the matter giving rise to the qualified opinion paragraph, it relates to the Governmental Accounting Standards Board requirement number 87 relating to leases. So during the audit, we found that the IDA has several different lease/licenses agreements with entities. I know there was over 10, at least 10 of them. And from their understanding and reaching out to the predecessor auditor, it doesn't seem like a consideration of implementing GASB 87 was made. With the timing of the audit, we agreed that it would make sense to carve this piece out for 2025 and qualify the opinion saying, except for this piece, we think everything is in compliance, and we let management know that there's options to address that. Whether they would want to consider a separate engagement with our consulting team to look at those leases, or if they want to do something internally, but we're more than happy to help provide some guidance on that for 2026, before the 2026 audit takes place. And then in addition to that, we have to document, as I mentioned, a restatement disclosure with the correction of the grant activity, which we have to document as a correction of an error. And what it's doing is correcting some prior year activity amounts for 2024, which we will see later. And like I said, another disclosure again, just saying we don't audit the management's discussion and analysis. That's why I will be skipping over that this morning. So if we go to page 8, the statement of that position, this will look a little bit different than you've seen in years past for a couple of reasons. One of which is that you're only seeing a single year being presented this year for the financial statements. And we thought this would be the best route for the first year audit. So then it would avoid issues going deeper into the prior year amounts and being at risk of making additional changes to the prior year amounts. Now that we have this 2025 financial statement set up, in 2026 and in subsequent years, we will have the comparative financial statements. So In 2026, you'll see a current year column and then the 2025 numbers we have here today also. And a couple of things that I wanted to point out on the statement of net position, in other words, your balance sheet, is the two changes related to our material audit adjustments relating to grants. You'll see that 131,000 being accrued in accounts payable, along with corresponding increases in grants receivable. Other than that, there wasn't any significant changes in activity from the prior year, just continuance of existing loan activity and nothing else out of the ordinary. And going on to the statement of revenues, expenses, and change in that position. Same thing here. I just wanted to highlight a few things. You'll see we had some adjustments with grant revenue, as well as adding a separate line to cover grant expenses. So under the accrual basis of accounting, typically these numbers match, and if they don't match, they're pretty close. Not all entities present their grant activity this way, having a separate grant expenses line, but I personally like this because then you're able to see the two numbers match, whereas in other instances, all of the expenses are blended into the other operating expense lines with the corresponding categories they would be in. Following with our opinion in relation to the leases, we do have that reported as a separate line. The railroad operating agreement, that is an agreement we did actually take some time to look at, and we, based on our opinion, don't believe it would fall under the GASB 87 standard. So we were okay with carving that out and making it its own financial statement line when it comes to revenue. A new piece this year under operating expenses was the Owego Creek stabilization project. It sounds like that will be a one-time, one-year thing. So we decided to carve that larger expense out as well. And then there was also a write-off of one of the loans during 2025. That's why we have this bad debt expense of about $13,000. And then in addition to that, you'll see our restatement, which we'll look at shortly, restating the beginning balance of net position. But overall, there was an increase in net position from the prior year of about 530,000, which is great. Are there any questions before I continue onward? I know I'm kind of going a little bit fast, so.
I have a question about the leases, but I don't know if this is the right time to ask. Will there be more? Will we be going into that more or in another area, or can I ask?
No, go ahead.
I'm just curious about the leases. So, because that's what caused or mandated the qualified opinion. So you said there's multiple leases, and are they multi-year leases? All of them?
Without going through all of them, I, from my understanding, some are. I would have to, Casey, you would have to confirm on that.
They're a mixed bag, Brenda. Some of this stuff is some of them are evergreen. They go back, like the one we've been talking about in our meeting, goes back to the 90s. Is just an evergreen. It's a very small portion of our overall income, but it is split between a lot of different tenants, so to speak. I mean, for a lot of them, it's very small pieces of land along the railroad.
Right. And so
I think the only ones that are regularly updated are the ones with Park Outdoor advertising.
Okay.
So
they're go ahead, Eric.
Is that the issue with the GASB 87? Is that we're just all over the place on our paperwork with those? What's the deal?
It would create a ton of work, wouldn't it, Ashley?
Well, it depends, honestly. So really the hard part of it is pretty much just looking through each of the agreements and comparing to the standard and saying, is this a lease? And then if it is, there's the whole calculation recording like it would be in this case, a long-term receivable relating to expected lease income as well as a deferred inflow of resources relating to it. So it is time consuming to start it, but once it's calculated, it's a matter of for bookkeeping purposes, looking at the table that the calculations were made on and recording an entry at the end of the year.
And
How does GASB handle evergreen leases that are technically outside of the original term?
So I can't speak to specifics with the lease agreements without actually reading through them, but that is something that our consulting team does. So typically with the lease agreements, when the standard came out, our consulting team rolled out engagements with a bunch of our clients. So it's a separate engagement letter, a separate engagement team, and what they do is go through all of them. They'll take all of the agreements from Casey, they'll go through all of them and say like, okay, this is a lease, this isn't a lease, they perform the calculations for you, provide a deliverable document saying like, here's all the lease information, this would be the journal entries you'd record this year, and this is what things will look like in subsequent years.
so we don't know for sure that all of these are leases. It's a possible that there may be some that don't qualify as a lease or might
Correct.
not meet this criteria, yet we still have a qualified opinion because of that, because we're not going through that process to determine that.
Yes, because the standard's not being implemented and based on the amount of income recorded, it's misstating the financial statements on the balance sheet side of things without having a long-term receivable and deferred inflow of resources.
Yeah, so it's a material amount, I presume, right? Do you know what our materiality threshold is?
It is not, it's not a high number. I don't remember it off the top of my head, but what I think happened looking at the revenue amount, it was, I would assume by the predecessor, looked at as an immaterial amount, but that doesn't account for the fact that the long-term receivable that is possible that should be on your balance sheet is a way larger amount due to the term settings of these agreements because of some of them, how often they renew, so how long the agreement would potentially be in place. Some of these could be, I'll make up a number, 30 years, and that adds up, and that can be a material amount on the face of the financial statements that's missing.
Yeah, my understanding is that the lease agreement would have to be for more than 1 year to meet that criteria. Is that right? For GASB 87?
And yes, in most cases, but there's a lot of agreements where they're subject to renewal, and that plays a role in consideration of whether or not it falls under the standard as well.
Mm-hmm.
I know that we have one lease that's for 5 years, and a lot of the other leases are not month to month, but year to year kind of thing. And it's if they want to renew every year. So with that, I think we only have one lease that has a specific timeline.
Mm-hmm.
I'm just like a little confused, I guess. So if you don't know if they're going to renew, would that be something that you would still use this GASB requirement?
So that would factor into the consideration is the expectation if it would be renewed or not. So like say they've been renewing it every year and there's no anticipation of them not renewing it, that would be considered in the calculation.
Okay.
But like I said, without looking at the specifics of anything, I couldn't give a definitive answer as to what the outcome would be for these specific agreements.
There's still a lease spreadsheet out there, isn't there, Casey? It's been a while since I looked at it, but maybe our separate audit committee folks, we could just bat that around and have a discussion about it afterwards, since obviously we won't be able to address it for this particular audit anyways.
Okay.
Well, it ties to kind of a bigger issue we've had over the last few years, right? Some of these leases are popping up and they're not, we track them, but You know what I mean? There's questions with some of them that we've had.
Well, yeah, I mean, a lot they don't receive a lot of attention again, just based on the nominal percentage of revenue in the
Number.
grand scheme of things, and really we only have one, I think, truly proactive tenant in Park Outdoor that they proactively contact us to renegotiate, whereas I think a lot of the other ones are on really long, just year to year evergreen agreements.
Okay.
Did that help answer your question at all? I know I wasn't able to be super specific when it came to responses, but
Yeah, that's helpful. I guess I'm just not convinced that I don't know, like John said, I guess it requires us looking deeper at the leases to determine if they meet that criteria. So, but yes, that's helpful. Thank you.
okay. Let's see. So going on to the statement of cash flows, I don't want to spend too much time on this, but I did want to point out that we did add the pilot activity on the face of the statement of cash flows, which pretty much just gives a financial statement reader a better understanding of the dollars going in and out being passed through in relation to the pilots. No, obviously, financial impact on doing that. It's just more of a presentation thing. So I just wanted to point that out because that's new from last year. Going on to the financial statement disclosures. I will scroll down to that restatement disclosure and zoom in a little bit for you guys. So this restatement disclosure kind of gives a clear perspective on how things impacted the 2024 financial statements. And as you'll see on this restatement, it's only going to be impacting the balance sheet because you don't necessarily restate income statement items for the prior year when it comes to looking at the beginning balance because it's already closed into net position, the revenues and expenses. So you'll see what the balances were prior, the impact of our adjustment, and then ultimately the updated balances as of January 1st, 2025. There was a little confusion with this in comparison if you look at the prior issued financial statements, because on the face of those statements, the grants receivable balance was recorded as accounts receivable. So this 42,000 is sitting on a line labeled accounts receivable when really it's grant related. So it should be presented as grants receivable. And then with accounts payable, I believe on the 2024 financial statements, it was presented on a single line with accrued expenses. And the total balance last year was related to accrued expenses and not accounts payable. That's why you see a zero balance here for our 12/31/2024 balance. And you'll see that the receivables were understated by about 149,000, and then accounts payable was understated by about 90,000. And does anyone have any questions on that?
So we have been recording receivables for grants and expenditures, but it's just a timing issue for this particular year. And is that something that seems like it's been that way for
Yes.
multiple years, the way things are being recorded? Or when they're being recorded, better said?
Yes. So it looks like, at least for when we were looking at 2025 and 2024, revenue was not being recognized until the cash came in from the whatever funding source it may be, and then expenses weren't being reported until actual cash went out the door. So it was kind of more of a cash basis recording of the activity when it should be recorded when the revenue is earned or the expenses are incurred. So one of the things that it's definitely tricky. So I think it would be a good idea to talk about this one more is the DRI program. So what, as you know, what the IDA is doing is that they're reimbursing someone else, a third party, for their expenses that they incurred under the grant program. The grant program gives the agency money, and then the agency in turn reimburses that third party for the expenses they incurred. So what's supposed to happen is that when those expenses are incurred, it's I'll call it a fourfold entry. So even though the agency doesn't have any money yet, hasn't done anything with cash yet, they have to acknowledge that the revenue was earned at the time the third party incurred their expenses. So they would debit accounts receivable, credit revenue, showing that that money is due to the IDA. But then in turn, it is due to the third party to be reimbursed, so they have to record an expense and accounts payable for the same amount. And the entry that I showed on our previous file doesn't obviously clearly reflect that, and that's due to a number of things based on how activity was recorded this year that was supposed to be in last year, and a couple of other things. So when you look at that journal entry, what I'm saying doesn't probably make sense because the entries don't look like that because a number of things are happening. But yeah, it's really just a matter of timing. But I know you guys have Beatrice now from Bowers stepping in and helping with the recording of activity. So obviously she'll be able to I assume in 2026 and beyond look into this further because she's very familiar with the process.
This is a tough one, Brenda, because Ashley, am I wrong? Is this all DRI money that's getting moved, basically?
Not all, but a nice chunk of it is DRI. So you can see some of those, yeah, like a majority of it is DRI stuff. But then there's some smaller pieces involved with it. This amount is flood mitigation grant money. This was the Raymond Hadley program, stuff that should have been in 24. And this amount relates to the workforce coordinator grant that should have been a receivable this year and partially in the prior year. But like I said, this entry doesn't cleanly show that.
Yeah, it's hard to see. But Brenda, just so you know, the DRI is a one-off, and that's really where I think that's going to be the most complicated of these. And
Definitely.
thankfully, I don't see that recurring because that's really tough. That'd been a way higher level of, from a board perspective, board oversight and management of those than we, I think, anticipated needing to be involved with. But again, that's almost done. These other ones we can better come up with ways to better show them as receivables and payables, depending on the situation.
Thank you.
And that brings us to the final piece of the presentation. So in response to the grant activity adjustments, we were required to present a finding that we consider to be a material weakness. It's presented as a material weakness due to the dollar amounts being material to the financial statements. And I won't go too far into explaining all of this since we've done a good job of talking it over thus far. We tried to break out each of the things by specific, not categories, but sort of. So these references where we're saying related to grants passed through to a third party, that's stuff relating to the DRI program. I don't recommend spending too much time worrying about the specifics because it'll be over with. And like John said, you're probably not going to have to worry about DRI much longer. But now we have an idea of like how things should be going forward. We disclosed the financial impact once again. Our recommendation simply just says take consideration of how the grant activity should be recorded. what kind of reconciliations need to be made to determine if there's receivables at year end or if there's anything due at year end to third parties. And we did receive a management's response from Casey. It was very well written, probably one of the best written ones I've received in a while, very clean, formal, and excellent. So we did add that to the financial statements as well.
Brittany wrote that, so she can have the credit for that.
Oh, well,
Not
awesome.
me.
Great work, Brittany. Oh yeah, that's all I had to cover with the reporting. I wanted to now give you guys some time, see if you have any additional questions for us or if there's anything I could provide clarification on.
I don't
This
think
might be
so.
a high level question, Ashley, but the amount of the bad debt expense that's out there, I mean, I know I'm pretty sure we've wiped out the one loan that was a bad debt and arguably could have been done in a previous year, but you don't by chance have a reconciliation of how the 13,000 was arrived at by chance, or was that straight off
Let me
of
take a
numbers
look. So getting that number comes from, where did the file go?
Because we wrote off a lot bigger amount, right, John? Is that
That's
what
what
you're
I
saying?
thought. I would have expected that number to have been bigger, yeah.
I think it's
Yeah.
42,000.
Right. Yeah, I remember it
Approximately.
being larger.
Yeah, so the loan amount written off was that amount, but also let me get the file open before I keep talking. So the reason why that bad debt expense is less relates to the accounting for it when it comes to recording a journal entry. If this file wants to open for me. All right, so what happened was that the total amount for the loan that was written off was a little bit over $48,000, but the agency already had an allowance for doubtful accounts reported in relation to that receivable. So at the end of 2024, they already had an allowance recorded with the expectation that they more likely than not weren't going to collect that amount. So what that bad debt expense represents is the net of the amount written off and that allowance. So the amount written off was $48,052. The allowance that was already there was $35,000. So once you wipe both of those out, you're left with a bad debt expense of $13,052.
Don't we have to still maintain an allowance for the existing portfolio, though?
Only if the agency believes that there's a need for one. So if they don't
Okay.
have any concerns or questions regarding collectability, there's no need to report one every year at year end, but the agency is still required to look at the loans at year end and say like, oh, do we think any of these are uncollectible and why? Do we have a basis for recording an allowance? And
Okay.
at their discretion,
Okay.
decide if one should be
Okay.
there.
So as long as we've got our reserve in place, we're covered there, and then we only have to come up with the allowance if there's a concern.
Right.
Thank you.
You're welcome.
Anybody else have questions for Ashley? Thanks for going through everything. Appreciate it.
Yeah,
Thank
no
you.
problem. And then if anything, I know we go through the presentation so fast, but if anything comes up afterwards where you're like, oh, I guess I should have asked about this, don't hesitate to shoot me an email or even see if you want to schedule a call if it's something that might require some more talking through than a simple email response.
Is the management's discussion and analysis, is that done and ready to go? Are we good with that? Or is that
Yes.
something? Yes.
Yeah, so we did receive the final pieces of that at the end of last week. So that is included in the draft that I emailed to Casey this or over the weekend since I had time Saturday to get that updated. So all of that is all set. So once we get the signed management representation letter, we'll be able to issue final reports to you guys and get everything done before that March 31st deadline.
Our accounting firm did offer a couple little things they wanted added. I was going to talk to you, Ashley, about it, see if I could just email it to you.
Yeah.
Okay.
And I have a couple things numbers that in there that I'm not sure about. So I guess I could maybe talk to you, Casey, or
Yeah.
somebody afterwards, so I don't take time now. So, okay.
Perfect. Thank you.
Thank you.
Yeah, thanks for everybody's work on this. I appreciate it.
Yeah, of course.
All right.
Yes.
All right. So if we're good, we'll have some offline discussions outside this meeting. I think at this point we can look for a motion to adjourn.
So moved.
Can we do a
Thanks, Eric.
recommendation to approve the audit?
Brenda, are you ready for that, or do you want to ask some questions, or?
I'm okay with that. I mean, if a few minor little tweak number things aren't a big deal, then I'm okay with that.
Okay. And what else do we owe? Obviously, I know I just got a copy of the management letter. I haven't even had a chance to look at it, so I got to read that over, and that needs to be signed. What else do you need from us, Ashley?
In addition to that letter, just let us know if you would like any physical copies of the final reports mailed out, and if so, how many, and once we issue, we can arrange for that also.
All right. All right, so at this point, I guess we'll look for a motion to approve the 2025 draft as issued.
So moved.
Second.
That's all of us, so we're in agreement there. Anything else? Eric, you still good with adjourning?
Yeah.
All right, 10:41. Thanks, everybody. Appreciate it.
Thank you.
Thank
Thank
you.
Great day.
Later.
Bye.
Bye.
Thanks, Ashley.
You're welcome. Bye.